When a man sits alone after the market closes, staring at numbers that no longer flatter him, that is when speculation truly begins. The noise is gone. The excitement has drained out of the room. What remains is judgment, honest judgment. Loss has a way of stripping a trader bare. It removes excuses, silences confidence, and leaves a man alone with the consequences of his decisions. Anyone who has spent time in the market knows this moment. The moment when you realize the loss is not just on the screen but inside you. The market has moved on, but you have not. And that is where most traders make their first mistake. They rush to recover money before they recover clarity. Losses are not unusual. They are inevitable. The question is not whether you will lose, but how you respond when you do. Can you recover capital without damaging your judgment? Can you recover yourself without rushing the process? Most traders ask the wrong question. They ask how to make the money back quickly. They stare at the chart as if it owes them restitution. The market does not respond to desperation. It does not hear regret. It does not adjust itself to your financial needs. Price moves according to supply and demand, not sympathy. And the trader who forgets this after a loss begins trading emotion instead of information. The first job after a loss is not recovery of capital. It is recovery of perspective. Without perspective, every trade becomes a gamble. With perspective, patience returns. And patience is the foundation of survival. Losses are rarely accidents. They are messages written in red ink. The chart usually told the truth long before the account reflected it. Most losses come from familiar causes. Trading too large, acting too early, fighting a trend that had no interest in your opinion. Losses feel random only when a trader refuses to examine his behavior. A loss is not the market being clever. It is the trader being human, impatient, proud, afraid. And if that sounds familiar, it should. Every trader who lasts long enough has paid that tuition. Recovery does not come from swinging harder. It comes from slowing down, from standing still long enough to see clearly again. The most profitable position after a drawdown is often no position at all. Sitting on your hands when every nerve demands action is not weakness. It is discipline. The market does not change its behavior because you lost money. Support does not move out of sympathy. Resistance does not soften because you are under pressure. Price follows structure, trend, volume, and time. And when you return after a loss, you must read the market as if you have never seen it before. Many traders fail in recovery because they trade memory instead of price. They anchor themselves to previous highs and try to trade back to them. That is a dangerous habit. The market does not remember where your account used to be. It knows only the current price. When you trade against memory, every tick becomes personal. And once trading becomes personal, discipline quietly leaves the room. Losses teach position sizing better than any book ever will. A trader who has been hurt by trading too large understands risk in a way theory never could. Unless greed convinces him he is healed, that lesson stays. Recovery begins with smaller size, smaller expectations, sharper observation. Confidence does not return by risking more. It returns by surviving long enough to rebuild trust in your actions. Confidence in trading is not a feeling. It is a byproduct. It comes from doing the same correct thing repeatedly. When size is reduced, mental space opens, you stop reacting to every tick, you begin to see patterns again. And patterns are the only honest edge a trader ever has. Many traders hunt for the perfect trade after a loss, the one trade that will erase pain. That trade does not exist. The market offers probability, not apology. Recovery is built through a sequence of ordinary, disciplined decisions. There is nothing heroic about it. If trading feels exciting during recovery, something is wrong. Excitement is often a signal of emotional involvement. True recovery feels dull, uneventful, almost boring. And boredom in trading is often a sign of control. Money mindset matters, but not in the way most people think. Trading wealth is not about positive thinking. It is about emotional neutrality. Money is a tool, not a verdict on your worth. Losses hurt most when a trader attaches meaning to numbers that do not belong there. Most traders think they are trading money. They are not. They are trading price. Account balance only keeps score. And like all scorekeepers, it reports after the fact. When a trader allows balance to guide decisions, fear and hope begin to replace analysis. Price moves because buyers and sellers are doing their work. It does not care whether you are down or up. When you focus on balance, you trade fear. When you focus on price, you trade information. Two traders can take the same trade. One calm, one desperate. The chart does not change, but outcomes often do. Desperation causes early exits, hesitation, rule breaking. Calm attention allows price to decide. Price action is clean when you allow it to be. Trends form. Ranges compress and expand. Volume speaks quietly before headlines ever do. But once personal finance enters the picture, perception distorts. The chart did not change. The trader did. The market is never wrong. Opinions often are. Account balance is an opinion. It tells you where you have been, not what to do next. Each trade must stand alone. If you would not take the trade with a smaller account, the trade is not based on price. There is discipline in trading price instead of money. You stop counting profit before it exists. You stop measuring yourself by daily results. You respect timing instead of forcing outcomes. At my best, I often did not know exactly how much I made or lost until the session ended. I knew whether I traded correctly. That separation protected judgment. The first risk in trading is psychological. Watching balance tick by tick poisons execution. Recovery begins when attention returns to price and process. Loss does not demand action. It demands reflection. The trader who understands this survives long enough to rebuild. There is a moment after a loss when something dangerous enters a trader's mind. It doesn't arrive loudly. It doesn't announce itself as panic. It comes quietly, disguised as determination. The urge to win it back at first, it feels reasonable, responsible even. A man tells himself he just needs one good trade to get back on track, one clean move to restore balance, one decision to erase the mistake. But that urge does not come from the chart. It does not come from price, structure, or probability. It comes from wounded pride. The market did not create that feeling. The loss did, and once the urge takes hold, it begins to distort perception. Speed starts to matter more than accuracy. Action starts to feel more important than patience. The trader stops asking whether a setup is sound, and starts asking whether he can pay fast enough. That is the moment speculation turns into negotiation with pain. Have you ever noticed how convincing that inner voice can sound after a loss? It tells you that waiting is dangerous, that hesitation is weakness, that opportunities are slipping away. But the market is never in a hurry. Only traders are. Markets move on their own schedule. They pause. They test levels. They shake out weak hands before committing to direction. A trader under pressure cannot tolerate that process. He wants resolution now. He wants the market to declare him right quickly so he can breathe again. So he enters early, before confirmation. Or he sizes too large, hoping to compress time. Both choices come from the same place. Impatience fueled by loss. Loss creates urgency. The market does not share it. That mismatch is deadly. When a trader feels rushed, he begins to see urgency in the chart where none exists. A small uptick looks like a breakout. A shallow pullback feels like the last chance to enter. Price has not changed, but interpretation has. An interpretation driven by emotion is unreliable. Winning it back becomes the goal. And once that happens, discipline becomes optional. Stops are widened because the trader cannot afford to be wrong again. Targets are shortened because he just wants the money back. Risk and reward quietly invert themselves. The structure that once protected him disappears without ceremony. The danger is not only financial. It is psychological. Each forced trade that fails reinforces the sense of being trapped. Now the trader is not just down money. He is down confidence. And confidence lost under pressure is not easily rebuilt. The urge intensifies. He trades more, not better. He mistakes activity for effort. The market, indifferent as always, keeps moving, and soon the original loss looks small compared to the damage done trying to erase it. The market offers opportunity every day, but it never offers urgency. Urgency is something traders manufacture when they stop trusting process. I learned long ago that whenever I felt I must trade, I should not trade at all. The best trades never beg to be taken. They stand out clearly, calmly, waiting for confirmation. If you feel pressure, you are early or you are wrong. One of the hottest lessons in speculation is accepting that time is not your enemy. Impatience is. Losses convince traders they are late, that they have fallen behind. But behind what? The market has no finish line. There is no prize for speed. There is only survival and consistency. When you feel the urge to win it back, you are trading your last trade, not the current one. You are responding to memory, not information. The chart in front of you deserves your full attention, but instead it shares the stage with regret. That divided focus is enough to turn a sound setup into a mistake. Can a man really read the tape clearly while arguing with his past? I found that the urge itself is a signal, not a market signal, a personal one. A warning light telling the trader to step aside. The moment I recognize that feeling, I stop. Not forever, just long enough for urgency to pass. The market will still be there. The setup will either form or it won't. But capital and judgment do not recover as easily as price moves. There is no trade that fixes everything. Recovery does not come from one bold decision. It comes from restraint. From allowing yourself to be flat. To be quiet. To be wrong without reacting. The trader who can do nothing when he feels the most pressure is the trader who lasts. Everyone else eventually trades themselves out of the game. I used to believe strength in trading meant aggression. I was wrong. Strength is the ability to wait when every instinct tells you to act. Strength is closing the platform after a loss, instead of searching for the next opportunity like a man chasing a debt. Strength is knowing that the market does not owe you recovery on your schedule. The urge to win it back is dangerous because it disguises itself as responsibility. It feels necessary, but underneath it is fear. Fear of being wrong. Fear of falling behind. Fear that the loss means something more than it does. The market does not attach meaning to your losses. It only responds to orders. When you trade from fear, your orders carry that fear into the market. And the market reflects it back to you in poor timing, slippage, and whipsaws. If you listen carefully, the chart will tell you when it is time to act. It always does. But it speaks softly. It never raises its voice to compete with your emotions. When the urge to win it back is loud, the chart becomes easy to ignore. That is why so many traders believe the market changed after their loss. In truth, the only thing that changed was their ability to listen. The market never apologizes. It does not explain in itself. It does not reward effort or forgive mistakes. It simply moves. And that indifference is something every trader must accept. Once you accept that there is no apology coming, you stop demanding immediate restitution. You stop forcing trades. You stop arguing with price. You return to probability, and probability does not care about urgency. It rewards patience. It rewards consistency. And it punishes those who confuse speed with skill. The trader who survives is not the one who recovers fastest. It is the one who recovers correctly. One of the quiet misunderstandings in trading is the idea of confidence. Most men think confidence arrives after a win. They believe it shows up once the account turns green again. That belief destroys more traders than any bad setup ever could. Confidence does not come from outcome. It comes from repetition. After a loss, confidence is usually the first thing to disappear. A trader begins to doubt his reads, his timing, even his understanding of the market. He waits too long, then enters too late. Or he hesitates, then chases. He tells himself he just needs one win to feel right again. But confidence built that way is fragile. It rests on something the trader cannot control. The next losing trade takes it away just as quickly. Real confidence is not emotional. It is mechanical. It comes from knowing that you acted correctly regardless of how the trade ended. That kind of confidence is earned quietly over time through behavior that most traders find boring. Markets do not reward belief. They reward consistency. The trader who survives understands probabilities, not as theory, but as reality. Every setup, no matter how clean it looks, carries uncertainty. A breakout can fail. A trend can reverse. A perfect pattern can dissolve without warning. The market does not owe you confirmation. Just because you followed your rules, you can do everything right and still lose. That is not injustice. That is probability playing out. Many traders struggle here because they secretly expect fairness. They believe effort should be rewarded. They did the analysis. They waited for the setup. Surely the market should acknowledge that. But probability does not work that way. Outcomes are scattered. Wins and losses do not arrive in comforting sequences. Can you stay consistent in the middle of that randomness? When a trader does not understand probability, losses feel personal. He begins to resent the market. He argues with price. He holds losers because it should turn here. He avoids good trades because the market has been bad to him lately. In both cases, he is reacting emotionally to past outcomes instead of objectively to current conditions. The market remains unchanged. His behavior deteriorates. Probability thinking removes entitlement. It replaces expectation with acceptance. You stop asking the market to be fair. You start asking whether the odds are acceptable. That shift alone can save a trader years of frustration. When you accept probability, losses stop being insults. They become expenses. Expected costs in a business where uncertainty is unavoidable. A trader who accepts this does not flinch at being wrong. He plans for it. Risk is defined before entry. Loss is accepted before it happens. And because it is accepted, it does not poison judgment when it arrives. This is where repetition matters. Confidence does not come from a big win. Big wins are poor teachers. They forgive mistakes. They encourage sloppy habits. A trader can break every rule and still make money once in a while. That is dangerous. It convinces him that confidence comes from profit. When the market changes, that false confidence evaporates. Small, well-executed trades do something different. They reinforce discipline. They teach a trader that he can act without panic and exit without regret. Even a small loss taken exactly as planned strengthens confidence more than a reckless win ever could. Why? Because it proves control. Control over size. Control over entry. Control over exit. Control over self. Confidence is not bravado. It is familiarity. A trader who has repeated the same correct process hundreds of times recognizes situations more quickly. He does not rush because he knows another setup will come. He does not freeze because he has been here before. His confidence is quiet, almost invisible, but it shows in execution. He enters when the market confirms, not when emotion demands. Many traders sabotage this by constant NTLI changing methods. After a loss, they abandon what they were doing and search for something new indicators, new strategies, new opinions. They believe confidence lies somewhere else. In reality, confidence is built by staying long enough with one approach to understand its strengths and weaknesses. How can you trust yourself if you never stay put long enough to learn? Repetition does not mean mindless trading. It means repeated correct decisions. Sometimes the correct decision is not to trade. That too builds confidence. Each time you sit out a poor market, you reinforce patience as part of your skill set. You begin to trust that you do not need to be involved all the time. The market is generous with opportunities, but only to those who survive long enough to take them. A trader chasing confidence through large wins often increases size too quickly. He wants the feeling back, the rush, the proof. That rarely ends well. Size magnifies emotion, and emotion clouds judgment. Confidence built through repetition grows alongside restraint. You trade small enough that mistakes do not define you. You allow yourself to be wrong without being wounded. That freedom is essential. Charts reward consistency. Patterns repeat. Trends behave in recognizable ways. The trader who shows up every day, reads price the same way, and executes the same plan begins to feel at home in the market. That sense of familiarity is what most people call confidence. It does not feel exciting. It feels calm. I used to judge confidence by how I felt before a trade. That was a mistake. Feelings fluctuate. Some days you feel sharp. Some days you do not. The market does not care. Confidence should be judged after the trade. Did you follow your rules? Did you respect your stop? Did you accept the outcome without argument? Those answers matter more than profit. Over time, repetition smooths emotional extremes. Wins do not inflate you as much. Losses do not deflate you as deeply. You begin to see both as part of the same process. That balance is earned, not hoped for. Many traders want confidence before they act. The market demands the opposite. You must act correctly first. Confidence follows later. You do not wait to feel confident to follow your plan. You follow your plan until confidence shows up on its own. The market has no memory of individuals, but it has a long memory for behavior. A trader who repeatedly respects risk stays in the game. A trader who repeatedly overreaches eventually removes himself. Confidence grows in the space between those two outcomes. It is not loud. It does not announce itself. It simply allows you to trade without second-guessing every decision. And that quiet certainty is what separates the trader who survives from the one who is always starting over.